construction and infrastructure development company Accentuate have increased their headline earnings per share by 99 cents to 6.99%, that is, to 6.86 cents for the 6 months to December. Standing by from the JSE to take us through the numbers is the company's CEO, Platt. Fred, great to have you on CNBC Africa this morning. Take us through the 6 months to December. Of course, a lot better period than we saw in the full year to June last year, where we saw you making a loss that was really around the CGA business, which you've now disposed of. But of course, Floorworks appears to be in a lot stronger position and continues to be a key earner for you.
Yes, thank you. Good morning. What we've seen over the last year or the last 6 months is a return basically to our original businesses, the businesses that we brought to the market, that being Floorworks and Safek. And we've seen an increase in trading activity, specifically within the area of Floorworks, which has allowed us to put a result on the table which is 100% or just close on 100% up in headline earnings year on year. During the period, we also disposed of the glass and aluminium division, which had been hemorrhaging and which had put a strain on the business up till effectively September last year.
Let's focus in on some growth areas for you right now, because of course, as you say, you have disposed of the CGA business. You're looking to focus on core competencies. Is this a period for organic growth within Floorworks, or are you eyeing out some opportunities in the market, perhaps spending the 9.5 million rand you booked from the sale of CGA?
I think a little bit of both. I think on the organic front, we are starting to see an increase in activity, specifically in the area of government spend. I think encouraging yesterday, the minister announced some specifics in the area of healthcare. We saw 30 nursing colleges and 5 tertiary hospitals, those being Chris Hani, King Edward, George Mukhari, Limpopo Academic and Nelson Mandela Academic, identified for refurbs for this year. So we're looking forward to a very strong organic growth within the flooring business. And we're obviously looking at leveraging off those synergies and our dominant position within the market segments that we service. In addition to that, we have identified a number of potential acquisitory moves, and I think we'll be making some announcements in this regard.
Well, the market looks forward to those. Do we have any clues as to whether they are aligned with the current business that you have, given the fact that you have said core competencies is a focus right now?
Yeah, I think we have understood, or we do understand, our dominant position within the resilient flooring market. We understand the opportunity to leverage off that. And I think that we've also learned from some of our mistakes, and we will be focusing in the areas in which we have the necessary competencies and which we can deliver to the market.
You've highlighted the fact that the private sector spending in terms of construction right now is still slow. That's a big concern for you in terms of holding back growth potential. Of course, public sector spending is set to increase. How much is your growth hinged on growth in private sector build?
Well, I think if we look at the performance of the company over the years, excluding the CGA performance, the company, has performed relatively well without public sector spend, and even without much, private sector spend. So there's been a lot of focus on refurbishments, et cetera, and that really, at the end of the day, pays the bills and the overheads. The additional public sector spend can have a marked increase in our activity, and we're anticipating a slow return to private sector spend in some of the identified areas in which we operate.
How are you moving into Africa? Because you have highlighted this obviously as a growth area. We know that it's one of the fastest growing regions, Sub-Saharan Africa, in the world. 5.5% growth is what we're looking at in 2012. How are you growing your distribution presence, and how are you evaluating the type of strategy you employ as you do this?
I think that everyone realizes, and certainly we at Accentuate realize the potential of the African market and have done so for some time. We've been operating within areas like Angola for the last 10 years. We recently concluded a hospital in Nigeria, and we have increased our activity on the continent generally. I think the key is twofold. The one is increasing our distribution footprint, and that is done through installers on the continent. And in addition to that, obviously, we need to take cognizance of the exchange rate. A relatively weaker rand gives us a huge opportunity on the continent, especially in our commoditized products. When the rand goes the other way, we need to focus more on the specialized products and looking at the distribution network on the continent.
In terms of cost control right now, tell us about where your margins are sitting and how this is impacting your ability to grow further, and of course the rand really a key factor for you in determining the type of products you focus on right now.
Correct. I think there's when we look at the relative strength of the currency, the African market, in terms of the products that we manufacture locally, certainly become a commodity product, and we can place it in the market at the right currency level. As far as managing our product mix, that really is a function of that. We play in an international market, and obviously the majority of our competitors are importers themselves. So the currency affects us equally with regards to imported product, but obviously impacts on our ability to manufacture locally at various levels. And we're very confident or very conscious of managing our costs. As far as margins are concerned, notwithstanding the fact that we've increased our market share over the last 6 months, we've managed to recover or to gain an additional 2% on our gross margin, which obviously impacts dramatically on our profitability.